Good morning, traders. Welcome back. So in this video, I'm going to give you an update on US30. So if you recall, I made a top-down multi-time frame price action analysis about a month ago when price action was here. Okay, and I'm going to link that previous analysis in the description below so you can check it out for further reference. So I made analysis when the market was exactly testing 35,500 psychological level in confluence with this supply zone all across this area, explaining all of the reasons why I expected price to make this accumulation, manipulation, and distribution, and I explained how I had downside targets below this low. I'm expecting a new monthly swing low around 27k. Okay, and the market has been following my projection perfectly ever since I made the analysis when the market was here. So the market sold off. Okay, the market sold off. Then I made an update when the market was here at around 33k, explaining all the reasons why, from a daily perspective, the market was overextended to the downside. The market had printed this huge M formation. After a harmonic formation, we expect the market to complete the pattern at the neckline. After a bearish impulsive wave, we expect a bullish corrective wave. And the market again has followed my projection perfectly and made a retracement back up to the psychological level of 34k, back up to the neckline of the M formation. And more importantly, after taking out the external liquidity with the swing lows, swing highs, external liquidity, so we took the buy side liquidity here, we moved from the external liquidity to the internal liquidity, and now we are targeting the fair value gaps, which are internal liquidity zones. Okay, so it's time to make an update because price has been following my projection perfectly. What I'm going to do, I'm going to clean my chart, and we're going to just start again from a top-down perspective. So from a top-down perspective, what we can clearly identify is the market here made a beautiful change of structure, a market structure shift. Why is this a monthly market structure shift? Very simply because this was the last monthly higher low. If you look at the structure of the market, we have the low, we have the higher low, we have the higher low, we have the higher low. This was the last monthly higher low in the bullish trend that created a sweep of the high, right? So then from this high to this low, the market changed structure. It broke below the previous higher low. This is a very, very important shift in structure from a monthly perspective. So this move from A to B is considered an impulsive move, not a corrective move, because we broke below the low. So generally speaking, after a bearish impulse, the market will provide you with a retracement before we potentially see further continuations to the downside. So here from a monthly perspective, as I stated in my last analysis, we have a monthly bearish impulse correction continuation pattern, and I expect to see lower lows. We take our Fibonacci from the high to the low, and you can see during the retracement move, we came into the 0.618 where the market started to accumulate, consolidate. Then we made the manipulation to the upside, spiking into the 0.786. And now price is making the distribution to the downside. So beautiful, beautiful price action here. Our downside target, according to the Fibonacci, our monthly downside target from the high to the low, as I said, is around 27k, which lines up perfectly with this level of demand that we've got exactly here. Unmitigated demand, right? This will act as a magnet to bring price towards it. So we've got a lot of confidence to expect lower prices from a monthly swing term perspective. Now, if we drop down to the weekly, what we can identify from a weekly perspective, I'm just going to draw on my wedge because it gives me clarity on the chart, right? So we've obviously got this wedge formation, which is where the market or how the market was consolidating, right? We had a consolidation for a number of months, a very, very large consolidation. Now, this consolidation trapped a various amount of traders. You see here, price made this double top, break to the downside, breaking below this low. How many traders do you think shorted here, right? On the retest of the supply zone, which created this break of structure, there would have been a huge amount of traders shorting that. Where do you think their stop losses are? Stop losses were above this high. Okay, that's exactly where the stop losses were, above that high right there. And as you can see, the market started to push to the downside, inducing more and more buyers. More and more traders placed their stops above here. And again, here we had weekly bearish engulfing candle. Okay, again, traders placing their stops above the high. Boom, the market made the manipulation into the stop losses that were residing above that significant high. So we swept the significant high from a weekly perspective right there. Then the market made a very, very important weekly market structure shift. So just like we've got on the monthly, so after the monthly bearish move, we had the monthly bullish correction. Then during the bullish correction, this is where the market structure shifted from a bullish correction to a bearish continuation, because here we broke below the previous higher low from a weekly perspective that created the sweep of the high. So we have a weekly market structure shift. Now the monthly and weekly timeframes are both aligning for bearish moves. What we can also identify from a weekly perspective, if you have a look at the previous weekly candle, it closed with a bearish 50% body and a 50% wick. When the market closes with this formation on a weekly perspective, there is a very high probability that the next candlestick will fill in the wick. This is because although we have a wick and a body on a weekly, on a daily this will look like an impulse and a correction, and you expect the continuation to fill in the wick. So we have confidence to see a move to the downside. What we can also identify from a weekly perspective is price has a beautiful level of imbalance from a weekly perspective exactly there. Now the market is always drawing to liquidity. What do I mean by that? The market will always move where the most amount of liquidity is in the market. Generally speaking, the market will go from the external liquidity, which is swing lows, swing highs, into the internal liquidity, which is fair value gaps, imbalances. So we took this external liquidity, the sell side liquidity below this swing low, and then the market's moving towards the internal liquidity with the fair value gap before making the continuation to the downside with the overall bearish momentum. So now if we drop down to the daily time frames, what we can identify from a daily perspective. Now, if you recall, I made an update on US30 when we were around 33k, explaining all the reasons why I expected a corrective move into this price that we are currently about to hit. And that's exactly what happened. When we get down to the lower time frames in a moment, I'm going to show you exactly how you could have capitalized on this move to the upside. So now price is approaching our area of interest. We take our Fibonacci from the high to the low of the daily impulse, and what we can see is we're about to test the 50%. We have the 0.618 just above us, exactly where the neckline of that M formation is. Also with the 0.618, we have that fair value gap. As well as the fair value gap and the 0.618, we have the as well as the fair value gap and the M formation neckline, we have the 0.618. So this is a zone of confluence. This is the optimal trade entry from a 4-hour daily perspective. And we're expecting price to get magnetized into that area. Now, if we drop down to the 4-hour time frame, this is where things get interesting. We're going to talk about this price action in a moment on the lower time frames, but here on the 4-hour perspective, we can identify that the market is testing this significant high. We can see that the market is testing this significant high, and there is definitely going to be a vast amount of stop losses above that high. So before I like to look for bearish continuations to the downside, which match my higher time frame analysis, my higher time frame order flow, I want to see this high get taken out, right? I want to see this high right here get taken out. Then I'll be happy to look for a move to the downside. So anywhere inside of this area right here, between about 34k to 34,200 is where I want to be looking for a short on the lower time frames. Okay, and I'm expecting very simply the market to make the lower low below these double bottoms here and complete this daily impulse correction continuation pattern. And obviously we've got a weekly wick to fill, we've got a monthly impulse correction continuation pattern. All of the time frames are almost aligning for the move to the downside, and this gives you higher probabilities. So now we've covered the higher time frames, let's now take a very quick look at the lower time frames, and I'm just going to explain to you guys how the market manipulates traders into trading in opposite direction before a reversal. So as you can see, the market was bearish here. We had a bearish market for consecutive 11 weeks or something, right? So during the bearish market, at the lows, the market started to consolidate. Where did the market start to consolidate? At 33,300, right? We had this consolidation here. Now, if you have a look a little bit closer at the consolidation, the market formed a significant low here and then made an impulse and broke above this high. Retail traders would have saw this as a break of structure and they would have started to buy. Where would they buy? They would buy here, they would buy here, they would buy here, right? Look at that double bottom. As traders start to buy this support, okay, support, 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 traders start to anticipate a corrective move because of the overextended market, which they were correct in doing so, but their timing was off. They got induced with this wedge formation. All of their stop losses would have been below this level of support. The market, boom, then ran into their stop losses, okay, then made the intended move. Now, have a look at the intended move. This was induced from NFP last Friday. The market here was consolidating in a bearish flag. What happens when a bearish flag breaks to the downside? What are retail traders going to do? They are going to be shorting this, right? So the market broke to the downside, retested the ascending trend line support, right? Let's just get that a little bit more accurate right there. Okay, so as the market broke the flag to the downside, retested, huge amount of traders on NFP tried to short that. Where do you think their stop losses were? Above the high. Where did the market move? Into the stop losses. So here on the NFP data, the market pushed to the downside, manipulated the masses into going short just as the trend reversed. Okay, that generated enough liquidity to fill the institutional orders and move the market in the intended direction. So since doing that, the market has obviously been bullish. This is a bullish corrective trend. Now, having a look at the lower time frames, okay, based on everything that I've just said, we've got that fair value gap just above us, right? We've got a fair value gap just above us. We've got that 34K just above us. What we also have is double top liquidity just above us. This is double top liquidity from the high of the previous day. You can see here as well, we've swept the stops above the previous week high. This yellow line is the high of the previous week. We've taken the stop losses out above that zone. Now, if we just go back to the weekly time frame very quickly, the low of the previous week, right, is exactly here. We should start to target that area. Now, the liquidity to the upside has been removed. The market should draw on the liquidity to the downside. Okay, so what we're looking for here from an intraday perspective to reposition ourselves short for any potential swing opportunities. What I can see straight away is there is this beautiful area of liquidity right here. Okay, you could draw it like that. You could draw it like this. We're going to go with the equal lows because it's just easier on the eye, right? So we've got equal lows, equal highs. Whichever way the market breaks first, it's very likely going to move in the opposite direction. Given the fact that we've got this bearish outlook based on all of the fundamentals, the technicals rather, that I've just explained to you, if price breaks this high, this is when we have higher probability to look for the short to target these lows. We have imbalance here, and this will be the first target. Obviously, like I said, we're expecting lower prices. Sorry, we're expecting lower prices in general on US30, right? From a daily, weekly, and monthly perspective, but we're looking to trade this on a lower time frame entry. Okay, so you can get a decent risk to reward if the market provides a valid entry somewhere inside of this zone, right? This will be the first area that I decide to take partial profits, should I be in the tech trade. But just bear in mind, guys, at the moment, the market is bullish from an intraday perspective. Okay, the monthly, weekly, daily, the monthly, weekly, daily are bearish. The 4 hourly, hourly, and lower are bullish. So we need to wait for that to align. We need to wait for the lower time frame alignment to give us high probabilities. So once the market takes out the high of the the weekly high, which is exactly here, okay, the current high of the week, all inside of this area is where we will be looking for continuations to the downside. I hope you enjoyed the in-depth top-down analysis. Don't forget to join our free Telegram group. The link's in our bio. Please comment below if you would like me to analyze or update anything next. Thanks, guys. Take care.